This is Bloomberg Surveillance Early Edition with Dani Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Global stocks kick off the second half of the year with gains, but some investors warn that chasing the rally from here is a risky move. Janet Yellen heads to China. The U.S. Treasury Secretary will travel to Beijing this week, becoming the second member of Joe Biden's cabinet to head to the Chinese capital in recent weeks. Charging ahead, Tesla and China's BYD set fresh quarterly sales records on surging demand for electric vehicles. Welcome to Bloomberg Surveillance Early Edition. I'm Dani Berger in London. Kriti Gupta is in New York. Kriti, it's the start of a new quarter with U.S. equities at a high for the year. There does seem to be a fair bit of unease with that fact.
There is and there isn't. What's interesting is if you are starting to see already at just 5 a.m. in the morning New York time, a little bit of divergence when you look at the benchmarks on the equity front. For example, futures kind of unchanged, perhaps showing a little bit of caution, but then you kind of go to those large cap, heavy tech stocks really showing up in the NASDAQ, and that's where you see your outperformance, which really tells you already right off the bat. So there are some fundamentals driving it because a good chunk of those gains are likely coming from Tesla, the overnight trade. We're going to dive into that story in a second. What you need to know on the macro front is that NASDAQ futures are higher by about 0.3%. What's interesting to me, though, is that yields are higher as well. So you are seeing some repricing in the bond market. 493 on that two-year yield. We're getting closer and closer to 5%. What does that say about the terminal rate that the market is pricing in for the Federal Reserve on this side of the Atlantic? Higher by about 4 basis points. I'm going to get that right. 493, like I said, on the front end of the curve. You go further out into the curve, and you are still seeing that same amount of volatility. So really interesting bond market dynamic, even the day before a U.S. holiday. What's interesting to me is the currency story as well, because it's not just the Federal Reserve at play, it's the BOJ as well. And what's interesting is that even though the BOJ has time and time again said, you know what, we're going to kind of stick to our yield curve control policy, not great news for the Japanese yen, which is why you're seeing dollar yen at about 144.75. Some weakness there on the yen side. But what's interesting is that there is an incentive now for a lot of folks to hop into Japanese bonds. That is going to be a hedging trade that's very much at play, really spurred by the weakness you are seeing in the yen. Sticking with that Asia story, I want to talk about China because overnight we did get some weaker data. Yet, Dani, copper, which is kind of our bellwether for China, higher by about 0.3%. What does that tell you about risk sentiment going into the U.S. session?
Well, I'll tell you what, Chinese consumers certainly buying EVs. All right, over here in Europe, we're still buying stocks. We're buying cyclical stocks, too. The best performing sectors are things like energy, basic resources, but just looking across the map, outperformers, FTSE MIB, that's also going to be cyclical. You have a lot of Italian banks who make up that index. UK stocks, FTSE 100, up about 1/3%. So to start this quarter, to start the second half of the year, European equities, the cash trade about 2 hours underway at this moment. We are indeed heading higher. Currencies, though, perhaps reflecting some of the weaker final PMI readings we've gotten in. We've had manufacturing readings for the first point. A lot of them are contractionary. Europe disappoints. France outperforms a bit, but again, we are in contraction. It is all about what is the strongest economy. What is the least dirty shirt? Perhaps that is the dollar today. It's not just stronger against the yen. It's strong against the euro. It's stronger against the pound. Sterling, cable rate, that's down about 0.2%. We continue to weaken, despite the fact that the first half of the year, the best performing G10 currency versus the dollar was sterling. Is that going to hold up this half as we have growth concerns rippling across the UK? And look, there's no catalyst necessarily for higher front-end yields in the UK in this gilt market. But that's definitely what we're getting. A lack of news maybe means that you just continue this trade that we've seen, and that is front-end sell it. We're up about 4 basis points. 5.3% is where we stand on the front end of this UK yield curve. Kriti.
Yeah, it feels like a lot of the market is really driven by the monetary policy. Surprise, surprise. But at what extent, or to what extent, does that transition to some of the geopolitics, which brings us to one of the major stories this week. U.S. Treasury Secretary Janet Yellen looking to travel to China this week as the world's 2 largest economies look to mend ties after bilateral tensions. She spoke about her expectations last week.
We really welcome and want to have a healthy economic relationship, and we think it's generally beneficial. We have disagreements. My hope in traveling to China is to reestablish contact. There are a new group of leaders. We need to get to know one another.
And joining us now is Bloomberg China economy and government editor Jill Desis. Jill, what do we know about the secretary's visit? We know it's been on the agenda for a little bit. We also know that it's following on the heels of State Secretary Anthony Blinken. What can we actually get, perhaps, from this three-day visit?
Yes, exactly. Well, I think that at this point, Yellen has been talking about wanting to visit China for quite a while now. This is finally her chance to do so. I think at this point, it's really about mending ties between the U.S. and China, or at least finding some way to keep open methods of cooperation and coordination. Really, this is a very, very tense relationship, as we all know. It has sometimes felt like it's just become even more tense in recent months. We've seen sanctions being involved. We've seen measures by Washington to try to cut off China from critical forms of technology. All of that is probably going to factor into this visit. I'm sure at this point, Beijing is going to want to try to push back on some of those measures that the U.S. is taking against China. That'll probably factor into her visit. From the Treasury Department side, they're also going to want to try to push China a little bit more on providing debt relief for distressed developing nations. That's been a really, really key focus of the Treasury Department in recent months. But really, again, as you mentioned, this is just coming off the back of the Anthony Blinken visit, Secretary of State to China very recently. That visit seemed like it was at least moderately successful in terms of keeping those lines of communication open. And ultimately, what we're looking to see is something that paves the way for an eventual Xi-Biden meeting later this year. That's something that Joe Biden has talked about wanting to accomplish at some point. And so this visit by Yellen kind of helps pave the way for that potential meeting later this year.
Elsewhere in China, we also had a shakeup of the PBOC, a new PBOC party chief. What can we read into this appointment, Jill?
Right. So this party chief appointment, Pan Gongsheng, what we're ultimately expecting is this possibly puts him in line to become the next PBOC governor. That's not a huge surprise, seeing as Yigan, the current governor, he was reappointed to this position just a few months ago, but he's already passed the retirement age that you would expect for a Chinese official at this level. So really, we were waiting to see what the next level of shakeup would be. This doesn't seem to be any like it's signaling any kind of a big giant change for the PBOC. Really, it's more about continuity than anything else. Pan is a pretty long-time technocrat within China. He's well known by the international community as well. He's had some overseas appointments working at Harvard and Cambridge, and then he also just has been with the PBOC for quite a while. So I think we can probably expect policy to continue, which is as it has been, which is important because remember, we've got a lot of downward pressure on the yuan right now, which I think is going to kind of put the PBOC's role in maintaining that in focus. And then also, of course, this slowing economic recovery momentum that we've seen in China. What does monetary policy easing look like in China going forward? All of that is going to be what we're looking to see how the PBOC adjusts in terms of big challenges going forward.
Jill, thank you very much. That is Bloomberg's Jill Desis. Now on to the Tesla story. They delivered a record number of cars in the second quarter, up 83% from a year ago. The EV maker has vowed to push for more volume, even at the expense of profit margin. Joining us now is Bloomberg Quick Take's Alex Webb. So Alex, if these numbers are coming in at a record delivery, is it success then when it comes to the strategy of cutting costs, upping volume?
So it is as it pertains to that strategy. The thing you've got to look a little bit further back at is what prompted the strategy. And of course, Tesla added something in the order of 1 million cars worth of capacity with new plants in Shanghai, Berlin and Texas, just at the time that demand was starting to slacken. And so what they've done is they've introduced a whole bunch of discounts and just generally price cuts. That has helped increase demand, but it has come at the cost of margin. If you look at Tesla's net margin last year, it was in the order of 15 to 18%, depending on the quarter. For the 2023, the market's expecting a 12% net margin. So it is clearly coming at some sort of cost.
And also, I think that positive kind of delivery record announcement also fueling some of the NASDAQ move this morning, at least in the futures trading. A similar story when it comes to Apple, at least traditionally, but perhaps this time giving investors a little bit of pause. What do we know about what Apple is going to do with their new virtual reality headset?
So the FT has an interesting story this morning, overnight, saying that Apple is cutting its production expectations and ordering fewer components from some of its suppliers. Now, we should take this with a certain pinch of salt because, firstly, all the numbers that we've had on what Apple's production expectations were have come from sources. Bloomberg has been amongst that, expecting about 300,000 units in the first year. If it doesn't hit that number, it looks like, according to the FT, it's because of supply issues pertaining to the micro OLED displays. Those are the things inside the headset, sitting in front of your eyes. They have some yield issues. They're not able to produce as many coming off the production line as they would like that meet their standards. Now, Apple's had this sort of issue before, for instance, with Face ID. The camera system in that didn't have the yields that they wanted. That pushed back the supply a little bit. Notice with this one, though, they were already going for quite a low number that they were expecting to sell next year. That gives them some wiggle room to fix any supply issues before they really think about scaling this into the millions of units, as many expect them to do.
Well, bringing things back to Elon Musk, as we unfortunately seem to do very often, a lot of people over the weekend, I myself included, got a message on their Twitter timeline saying what your rate limit, your tweet limit was maximized. Elon Musk follows up with he's limiting things. I know that we don't want to speculate too much exactly what's happening, but just what does this mean in general for Twitter as we continue to assess the direction with Musk at the helm?
He's in a business at the moment where he's trying to bring advertisers back. And the thing advertisers like is engagement, i.e. spending more time on these platforms. It gives you a greater opportunity to put ads in front of the users. If he's having to cap the amount of time or amount of tweets that people can see, I'm a pretty heavy user. I tend to have Twitter open all day. I've not yet encountered, still only early in the morning, certainly in the US, I've not yet encountered that break. But it does make it harder to sell ads. The other side of it is costs. Is there an issue here where if they are getting, as Elon Musk states, that they're getting lots of scraping happening from AI algorithms or AI training algorithms, then that adds to their server costs. So they've presumably had to make a cost-benefit analysis here of, are the costs too high on the server end, or do we need to be serving people these tweets in order to get ad revenue? And they've presumably gone for the first part.
Right.
Yeah, a lot to digest from Tesla to Apple to Twitter. Bloomberg's Quick Takes, Alex Webb, all over those stories. We go from the tech story to what's happening in France. Protests there continuing for a fifth night over the police killing of a teenager. Some 45,000 police were deployed in an effort to contain clashes that left hundreds of public buildings and shops damaged or ransacked. For more, we're joined now by Bloomberg's Caroline Conan in Paris. Caroline, talk us through this fifth night of protests. What are we seeing? What is the reaction from the government?
It seems like the peak of these riots in France may have passed. We only saw about 150 arrests last night compared to, for example, 1,300 on Friday and 700 on Saturday. So it seems like this presence of 45,000 police officers every night to protect those servers, to protect the public buildings across France is somehow making things a little bit quieter. Also, we've had calls from the grandmother of Nahel, this teenager who was killed by a police officer last week, a call to end this violence, also calls from the soccer player Kylian Mbappe, who's very popular among this young crowd because the rioters are often very young, between the age of 14 and 18 years old. They also come usually from those so-called banlieues, these low-income, undereducated, underemployed families in the suburbs of Paris, but not only, also the suburbs of other big cities such as Marseille, where we saw also a lot of riots over the weekend. So we'll see if this situation de-escalates over the next few days.
Caroline, as we take a step back and look at how this situation evolves, what about the economic cost? How much will this end up costing?
At the moment, the Finance Ministry is estimating that the damages to the public buildings will cost a minimum of 100 million euros, but of course this number is likely to rise if the riots continue over the next few days. President Macron has held crisis meetings after crisis meetings over the past week. Today is meeting with the presidents of the National Assembly and the Senate, and tomorrow he's invited more than 200 mayors of all these cities that have been targeted by the riots over the past few days. So we'll see also whether there is some kind of plan of action for these suburbs to really try and deal with the deep issues that these young people are facing and their integration into the French society.
Caroline, thank you very much for that update. That is Bloomberg's Caroline Conan in Paris. Now, coming up on the show, Poland increases security at its border with Belarus amid lack of clarity on the Wagner leader's whereabouts. We're going to get the latest next. And we're going to be speaking to Anneka Treon. Van Lanshot Kempen, chief economist, will join us in the next hour. A lot to discuss, including a spike in oil prices happening just in the past few moments. Saudi will be extending voluntary cuts of 1 million barrels a day through August. That headline just coming through. You can see the immediate price reaction. Oil is higher as there are concerns about the economy. The other superlative to alert you of, yield curve is inverting even further. It's just hit its most inverted level since 1981. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Dani Berger in London. Now, a week after an aborted mutiny from the Wagner Group to Moscow, there is still little clarity about the operations of the mercenary group and the whereabouts of its former head, Yevgeny Prigozhin. For more, we go to Bloomberg's Maria Tadeo in Brussels. First of all, Maria, do we know where Prigozhin is?
Well, if you listen to the words of Alexander Lukashenko, and this is a huge leap of faith, obviously, he is in Belarus and he is in Minsk. But the issue here is that we have not really seen any footage or any pictures of Prigozhin to confirm that information. And the last time we actually heard from Prigozhin was a voice note. Remember, it was 11 minutes long, and he repeated the main message here is that he did not want to topple the Russian government, that he did not want to go against the Russian authorities. Beyond the man himself is what happens with Wagner itself as an institution. And remember, Vladimir Putin gave them three choices. He said, you either join the Russian army, and according to the Kremlin, they were being paid already by the Russian MOD for a year. They paid their salaries, or you could go home or exile and head to Belarus. At this point, it really is unclear how many Wagner fighters have joined the Russian army. But of course, we know that the war continues, and this number could be critical in terms of how the operation in Ukraine is going on.
There also seems to be this fear in Poland of what the fallout from this might mean for them. They've deployed forces. That includes anti-terror units. Maria, what exactly is happening? Why is there this concern from Poland?
Yes, and of course, again, this is a neighbor to Belarus. In fact, they share a big land border, the Polish and Belarus. And we had a statement yesterday from the Interior Minister of Poland saying that they will deploy and relocate 500 officers to the border. That is additional personnel to the border in response to what they believe is now an increased security risk for the country because of Prigozhin and because of this idea that Wagner fighters could join him and actually head to Belarus. We should also note this is not the first time we've seen real tensions break out between Belarus and Poland. Remember, about 2 years ago, Poland accused Lukashenko of sending thousands of illegal immigrants to the border to create tensions, and that led to a week of turmoil. Beyond that, we should also note that this year there is an election in Poland. We don't have a date for it yet, but for the Polish government, this is also about presenting itself as being tough on Russia, tough on Belarus, and of course, any migration that may stem from it.
Maria, thank you very much. That is Bloomberg's Maria Tadeo in Brussels. Coming up, major U.S. banks raise their dividends following the Fed's stress test. We'll have more on that for you next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London. Kriti Gupta is in New York. Now on to some banking and finance corporate stories that caught our attention today. Barclays is seeking to end its corporate relationship, its banking relationship, that is, with OD Asset Management. According to the Financial Times, the hedge fund has been battling to contain investor exodus after a June 8th article by the newspaper that alleged that founder Crispin Odey mistreated women over a 25-year period. Now, elsewhere, the FT is also reporting that UBS plans to make clear its rescue of Credit Suisse won't rely on funding from Swiss taxpayers as a political backlash against the deal bids ahead of national elections. Separately, a Swiss newspaper is also reporting that UBS isn't planning to take Credit Suisse's domestic unit public. Kriti, I can't help but think these two stories are related. We're holding on to the public unit, and we're not going to be using taxpayer money.
I mean, it's a pretty good turnaround, I would say, from what we were expecting initially with the takeover, which is simply that they would gut the company. So to be able to kind of withstand all of this is, I would say, a pretty impressive scorecard here.
Yeah, fair enough, although a fair amount of folks from Credit Suisse will no longer be working at the combined firm. Hey, Kriti, we're also tracking U.S. banks, too, because J.P. Morgan, Wells Fargo, Morgan Stanley, and Goldman Sachs all announced that they would have higher dividends. They led this. That's, of course, after the stress test. Of course, Kriti, we still need to find out details about capital requirements in Basel III and sort of any other fallout from the regional bank crisis.
Yeah, but this is like so typical of the banks. As soon as they get kind of that flying colors acing of those stress tests, immediately they're going to put out their dividends. It's going to boost the stock. But I think the capital requirements thing is the biggest risk. We had Shali Bassick on, our Wall Street correspondent, on the show last week, and that's kind of what she warned about. She said that reporting of where you could have a massive increase, well, that also has an effect not just on the stock, but just how much loans they're willing to give out too.
Yeah, we need the details, but we heard Powell in front of Congress saying it could be as much as 20%. So they could be facing a much steeper cap requirement. All right, coming up, Kriti and I are going to be speaking to Anneka Treon, Lanshot Kempen, chief economist. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Global stocks kicking off the second half of the year in the green, but some investors warning that chasing the rally from here might just be a risky move. Meanwhile, Janet Yellen heads to China. The U.S. Treasury Secretary will travel to Beijing this week, becoming the second member of Joe Biden's cabinet to head to the Chinese capital in recent weeks. And charging ahead, Tesla and China's BYD set fresh quarterly sales records on surging demand for electric vehicles. I'm Kriti Gupta in New York with Dani Berger in London. Dani, it feels like out of all the headlines, all the geopolitics, all of the monetary policy story, it feels like the EV story might just be what's driving markets, at least in today's session.
Yeah, it certainly drove it in the Asia session. We saw all those Asia EV car makers really outperform. Maybe you can read into the eco story of that, too. They're still willing to buy cars, although maybe it's Tesla, which is more discounted. Maybe not hugely fitting into the European session, but we are looking at a lot more of those cyclical type stocks outperforming. Euro Stoxx 600 up 0.2%. It's things like basic resources, energy. That's what's doing well. I know you're going to get to the oil story in just a moment, Kriti. Meanwhile, though, when it comes to currencies, most of these European currencies are having a hard time finding any strength versus the dollar. Both sterling, both the euro are weaker versus the dollar. Sterling especially so. Maybe this is starting to fade that strength in the first half of the year. The pound was the best performing G10 currency for the first half versus the dollar. Surprising considering what's happening on the economy. And Kriti, this is also reflecting what's going on in the U.S. We do see yields on the front end continue to march higher. Same thing happening in the U.K., 5.3%. That is a gain of 3 basis points for 2-year gilt yields.
Certainly a lot to digest in the FX space and the bond space. So maybe that's where I start as well, Dani. Simply with perhaps what we saw in the Asian session, continued weakness in the Japanese yen, even though we did get perhaps weakness in other parts of Asia as well. It is Japan's currency that got the brunt of the hit, pushing the dollar alongside the euro, as you pointed out, 144.65 on that currency pair. Remember, there is some bond hedging at play here because the weaker the Japanese yen gets, the more attractive Japanese bonds get in terms of a hedging perspective. So really keep an eye on that interesting dynamic. Again, Again, bringing it back to the U.S. bond story. 2-year yield at 4.92, higher by about 3 basis points. We're inching closer and closer to 5% on the front end of the curve. Remember, that was what the terminal rate the market was projecting. I wonder how that changes as, again, we get closer and closer to that 5% technical level, and whether or not it actually even stays there or even surpasses, bringing us to, again, what we're seeing in the stock market. We talked about this, Dani, when it comes to kind of the EV story. A lot of it is coming out of China. Remember, China is the leader in electrification globally still, despite Tesla trying to expand globally and other EV makers kind of entering the fold. Nevertheless, it's giving a little bit of a tailwind to NASDAQ futures, higher by 0.2%, really outperforming what you're seeing in S&P and Russell futures. I think the story of the last 15 minutes or so, though, comes to the commodity space. Oil in particular, looking at Brent crude higher by 1%, trading with a 76 handle over 2 headlines. The first, Saudi Arabia extending their voluntary cut of 1 million barrels per day through August. That was that initial spike that you saw right here. Pairing it a little bit, now ticking higher again on a second headline that Russia is also going to be voluntarily cutting oil exports by about 500,000 barrels a day in August, something that the energy minister Novak said was something that they're doing to stabilize the oil market. Nevertheless, the combo of that putting oil at about a 76 handle, Dani.
And of course, we're going to have some OPEC meetings throughout the week, so interesting to see that ahead of it. Kriti, it's worth taking a pause, taking a beat, and wishing maybe an unhappy birthday to the yield curve. Nearly 1 year ago exactly, the yield curve inverted, and it has stayed there ever since. Here's the strange thing, though. We were all dour about the economy, but over the past year, over the past month, to be more specific, we've had some really strong economic data. In fact, the Bloomberg Economic Surprise Index is at its highest since 2021. In other words, the economic data has been beating expectations from analysts by the most since 2 years ago. So what is right? Is it the economic data, the surprise, or is it this bond market? Let's bring in now Anneka Treon, chief economist at Lanshot Kempen. Anneka, is the bond market too pessimistic, or is that inverted yield curve just showing that, yes, at some point we will indeed be getting a recession?
Hi, Dani. Well, it's the question everybody is asking. Are equities market right or are bond markets right? And history normally tells us that bond markets are leading and we should follow there. I think that there's 2 complicated factors. One of them is the divergence between monetary policy and fiscal policy. So while all central bankers across the world are becoming more and more stubbornly hawkish, fiscal policy is, reaching record amounts of stimulus that's being granted across the board. That's one. And I think the second thing is, because central banks were too late to deal with inflation has become embedded in the services sector. Labor markets are very, very strong, and that's a massive supporter for the economy.
So I translate that for me into your economic call then. Are we still going to get a recession in the U.S.?
Well, I think it all hinges upon one thing, which is, and it's not only the U.S., I think it's broader. Are central banks going to stick to their 2% inflation targets? And are they going to behave accordingly? And it's all about this. And that's perhaps why the Fed even introduced a pause in the first place, also being very data dependent. If central banks acknowledge the fact that we are in a structurally higher inflationary environment, also thanks to the fiscal policy, also thanks to rewiring of global supply chains, the effect of Russia, Ukraine, etc. If that's the case, then central banks can actually take a step back and not feel the urgency to crush services inflation, which is actually, as I said, the labor market's been very supportive. If central banks remain very dogmatic about the 2%, in order to restore credibility, they're going to simply keep having to go on. And if they keep going on and keep raising rates, that could indeed trigger the recession that, we've all been talking about since September, October of last year.
Yeah, I would argue perhaps even longer, depending on just how bearish you are. Anneka, talk to us a little bit about perhaps the payrolls report that we're going to be talking about on Friday. If you're talking about recession, perhaps one of the first indicators that we're headed there is softness in the labor market. What are you expecting on Friday?
Yeah, so that, the biggest surprise thus far, well, there's been a few surprises, as you've also shown in the surprise index, but one of the biggest surprises is the strength of the labor market. It's been rock solid. And we've all been looking at these indicators at the cuff, which shows the slight weakenings, especially if you look at, layoffs, etc. So again, in these payroll data, we will be looking at it. And I guess everybody will be doing the maths, which is to what extent are wages growing nominally? and what is happening to core inflation, because obviously inflation is starting to come down, but the sticky part is core. And if we get to a point that wages are growing, real wages are growing faster, so wages are growing faster than your core inflation, that's obviously a continuing supporting factor for the economy. So that's what everybody will be looking for.
So, Anneka, that's the kind of broader story. When you look deep within the numbers, we're looking at average hourly earnings that aren't necessarily improving when you look at real wages. We're also looking at productivity numbers that have been dropping, I want to say, for several months, if not a year now. Talk to us a little bit about how that compares with the AI story that is perhaps driving the equity markets to a lot of green on the screen. There is a narrative out there. I think Larry Fink over at BlackRock, the CEO there, came out and said the AI story, the acceleration you're seeing in that part of industry could actually help the deterioration you're seeing in productivity. How are you thinking about something like that?
Well, it's interesting what you say about the AI story driving equity markets, because the reason they're driving equity markets is obvious, right? Look at the share price of all those, AI beneficiaries in the market, which contributes to earnings growth, and everybody likes that, and equity markets go up. But there's one that's slightly deeper, but perhaps more interesting, which is, I've just mentioned that there are a lot of structurally inflationary forces working its way through the market, which is why many are questioning whether 2% is the right target or 3% should be the new normal. And as you mentioned, as Larry Fink has also been talking about, the one major deflationary structural force out there could be AI. Let's talk about productivity, as mentioned. AI could be the factor driving productivity growth. And obviously, if AI can really play its role in managing that, and therefore managing a more sort of healthy long-term inflation as a result of that, that's also very supportive to equity markets. The big question is, how much of AI working its way through to increasing productivity is sort of something we already, we're thinking about, which will only pan out far in the future, and how much is, actually going to move the needle in the shorter term.
Anneka, I can't help but think, as you and Kriti discuss the impact of AI on jobs, as I attempt to get Kriti to ask you a question about our start and go full walk, I can't help but thinking, how far outside the historical norms are we? Are we at a point right now, Anneka, where a lot of the models we typically use to assess this economy, to some degree, they're just not working right now, considering how different this time around is?
Yeah, and it's that famous "this time is different," and it gets so complicated because it always sounds so logical and sensible to say this time is different, but in looking out in the future, you say, well, in retrospect, it wasn't. But I think the two major factors that we need to take into account in the "this time is different" rhetoric is, as mentioned, the divergence between monetary policy and fiscal policy, and this is huge. Think about the trillions of euros, dollars that are being put out by governments, be it national security, be it infrastructure needs, be it the Inflation Reduction Act, be it climate change spending programs. And these are hugely beneficial to the economy and to markets, to jobs. So central bankers can do what they like. They can up rates, they can make mortgage rates more expensive, credit loans harder to come by. But that factor is huge. I think that's one. And then the other one is obviously technology. We've seen technology waves in the past, but the speed at which AI is really accelerating things is obviously quite new for us.
I love that you mentioned that divergence between monetary and fiscal, because, of course, that is a major conversation stateside as we get, even just last week, the Supreme Court kind of knocking down President Biden's loan forgiveness program. He's coming back and saying we're going to find alternative measures. How are you thinking about that from across the Atlantic? Is that something you're worried about, what the Biden administration is perhaps doing to help people who can't really live at a time when the Federal Reserve is saying we need to go even harder on inflation? How do you square the two?
Yeah, I mean, I guess what Biden is also referring to, but it's all about the consumer. And the one reason for why the economy is holding up much better than expected, again, you've mentioned it. Let's rewind back to September, October of last year. Had we known that the GDP numbers of Europe would only be a slight negative, we would have been over the moon. We, at that point, were predicting the darkest period for Europe in decades to come across us, given energy crisis, etc. US, we've been harping on about an aggressive story about US recession. Look at Q1 GDP growth. It's really strong. Q2 very likely to be positive again. So I think from that perspective, the consumer has played an incredibly important role. Part of it was the fact that you had these pent-up savings around the pandemic. Savings rate has fallen from pre-pandemic of 10% to 4%. There's still a runway ahead as long as consumers feel comfortable and confident. And because the headline inflation numbers are coming down, because the job markets are so strong, consumers continue to feel quite comfortable. And I think that's the point. That's what everything is hinging on.
Yep. Consumer confidence data, those surveys continue to come in strong. Hey, Anneka, really great to speak with you this morning. We appreciate your time. Anneka Treon there. Thanks so much. Now, coming up, stock momentum continues into the second half. We're going to take a look at 10 things to focus on in the next quarter. Our Bloomberg Intelligence team has the details next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London. Kriti Gupta is in New York. Now, we're officially in the second half of the year. Congratulations, you made it. And Bloomberg Intelligence has laid out 10 focus ideas to watch for the third quarter. Joining us now is the man behind it, Tim Craighead from Bloomberg Intelligence. All right, Tim, so we got 10 companies. Tell me about them.
So the basic idea, I'll take a step back, of our focus ideas are companies where we see three things going on. Number one, our analysts have a very strong fundamental call. Number two, they believe that their view is different from what the market is discounting. And number three, they see catalysts ahead that can shift the mindset. And there's about 100 of these across sectors, across regions that our analysts have on an ongoing, actively managed basis. These 10 all have catalysts that are coming up in the third quarter that we think are particularly notable.
Tim, talk to us about the AI story, but specifically as it pertains to Alphabet. And I'm so curious about this because a lot of the kind of creators of AI or the front runners of it have come out and since said, actually, this is dangerous technology. This is something that the market is far getting ahead of themselves with. How are you applying that kind of thinking or that kind of rhetoric to a company like Alphabet that has their hands in a million different things?
Yeah, no doubt. And I guess our view on this is that, you know, the focus is on NVIDIA and semiconductors, and, you know, obviously a number of stocks have gone to the moon accordingly, and that it could be bad for the basic search business that, you know, is all about Google within Alphabet. We would argue that actually as AI continues its rapid adoption, that that's going to be really good for Alphabet's cloud business more broadly. And that is going to overwhelm any risk that there is to search. And beyond that, you know, they have YouTube, and there's a lot of interesting things going on within that business that will continue to benefit the company.
I don't want to talk about AI. I just want to talk about cheesecake. I mean, I wish it was the actual cheesecake. I wish you brought it on with us. But I see on here that the Cheesecake Factory is one of your 10 stocks. I need to know more about this. Well, what exactly are you looking at here?
Yeah. So these aren't all positive ideas. There's 6 that are constructive. There are 4 that, you know, are situations where we have concerns. And you all have been talking in the prior section about economic slowdown and risk, and, you know, is it going to happen or not, et cetera. You know, we do see with Cheesecake Factory a potential concern. And that is that in the midst of a slowing economic environment where interest rates are high, consumers are pressed, that expectations are really robust for Cheesecake's comp store sales on an ongoing basis. We think that's really far-fetched. We think that comp sales may, you know, essentially come back down to levels pre-pandemic as opposed to double that's currently in expectation.
I feel like it should be like beer, though. If you're sad, you go drink beer. If I'm sad, I'm going to go eat a piece of cake, Tim.
There you go.
Some pretty solid logic there from Dani Berger. Who I will also point out is in the middle of London, a big kind of center for food, and she said that if there had to be one restaurant she would pick to eat her for the rest of her life, she would pick Cheesecake Factory. I'm just putting that on the record.
I would.
There.
Their menu is huge. You'd have so much diversity of opinion. Okay, Kriti, I'm gonna stop buzz marketing Cheesecake Factory and then wrap it up here. Tim, thank you so much for joining us this morning. That's our Bloomberg Intelligence's Tim Craighead. All right, coming up, the market moving events you need to be watching this week. Kriti and I have it all covered for you and the pre-market movers. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Dani Burger in London. Kriti Gupta is in New York. Now let's take a look at what's ahead this week. It is a busy one despite the holiday. We're going to be getting U.S. PMI and ISM manufacturing later this morning before U.S. markets close early ahead of the 4th of July holiday. Then, overnight if you're in the U.S., but early here in the U.K. on Tuesday, we're going to get an RBA rate decision on deck. They're expected to speed up the pace of hiking yet again. Then FOMC meeting minutes come back out on Wednesday. And then on Thursday, U.S. Treasury Secretary Janet Yellen begins her trip to China. Now, finally, we're going to round out the week with U.S. payrolls data on Friday. Kriti, I know you're going to be watching this one, perhaps for productivity, wonky details and all.
Well, I mean, I'm still obsessed with the fact that Larry Fink says that the AI kind of boost can potentially help or offset some of the decline we're seeing in productivity numbers. And that makes sense for a lot of the folks who are saying working from home is not a positive thing for the economy. And again, that's just one case to be made in the marketplace. But of course, I'm watching a lot of the micro as well. Pre-market stocks is where my head's at, specifically when it comes to the move you're seeing this morning in electric vehicle stocks. It's fueling a little bit of a boost in NASDAQ futures, but at the top of mind, we have to hit it. Tesla shares higher by 6% already. Look, a record number of deliveries. They really scaled up. They kind of took a hit on their margins, but it's still something. It's a strategy that was initially met with a lot of resistance, and yet they are able to kind of pull through and at the same time impress investors at the same time. Dani, this is pretty impressive, I have to say.
Yeah, right. 83% jump year over year. And I think you put it really rightly. Look, this decision of them to cut prices, prioritize volume, it had been really criticized. But here's the thing, these numbers are really strong. And part of the goal of Tesla, too, was not just to get the demand, but also deliver more vehicles, too, and not have this inventory glut. And they were able to do that. So the numbers match up that this play by Tesla, at least for now, it's been successful.
And I wonder how much some of its peers like General Motors and Ford, which are also trying to do the same thing, kind of take a page out of Elon Musk's playbook and do a similar story. He said, Dani, that the Tesla story was going to fuel NASDAQ futures. Well, perhaps a counterforce to that is what you're seeing in Apple. The FT reporting that they are cutting their Vision Pro goals after some production issues. That is the virtual reality set that they had kind of boasted a few weeks ago at their, I don't know what it's called, their show. There's a word for it, but their Worldwide Developers Conference. That's what I'm thinking of.
Yes, that's it.
Down about 0.2%. Give me some time. Eventually I'll get there. But I think the move there is interesting because, of course, Apple is also a heavyweight. It did also hit, by the way, $3 trillion in market cap last week. So perhaps seeing a little bit of a pullback then. Of course, it is kind of a weird day in the U.S. session given tomorrow is a holiday. So perhaps light volume not playing in their favor.
I almost called it a web developer palooza, but I knew palooza wasn't the correct word. Honestly, they should think of renaming it to that. This is interesting because the thing itself, look, it just looks like a pair of ski goggles. But part of the reason for this delay, according to the FT, is that these are just so complicated to make. It's a lot of tech going into this, and it's not even clear how much demand there is for this, too. Google have tried in the past, perhaps unsuccessfully. But yeah, I guess we're going to have to wait a little bit longer to see these become mainstream.
Yeah, a lot of focus on their products as well. But I have to say, you know me, I was obsessed with the antitrust story last week. Well, look, it continues on Monday as well. This time it's in the biotech space. And Dani, this is really important because Gilead Sciences is one of those key biotech stocks that a lot of people play. Well, it's taking a little bit of a hit this morning, down about 1%. They were cleared for their pay to delay HIV drug. What's important here is they were partnering with Teva Pharmaceuticals. It got pushed back from some antitrust. It looks like they've now gotten the all clear, so you have a little bit of the M&A arbitrage at play. But again, antitrust going everywhere from big tech to biotech. It's playing into the story.
Well, Kriti, as we head out to the end of the hour, I do just want to give us another check on oil. Oil rallying more than 1%. Two hotheads on your terminal. Saudi is going to be extending voluntary cuts of 1 million barrels per day, as is Russia. Less supply there. Oil spikes. This is Bloomberg.